We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks struggling to snap a losing streak here. The S&P 500 on track for its 4th straight day of declines. Home Depot narrowly beating expectations in the 4th quarter, boosted by positive same-store sales growth for the first time since 2022. Still, the home improvement retailer issuing cautious guidance for the full year. Hims & Hers plunging after the company confirmed it will stop selling compounded versions of weight loss drugs. This after the FDA declared weight loss drugs are no longer in shortage, removing a loophole that allowed the company to sell the products. And crypto stocks falling as Bitcoin hits its lowest level in 3 months, now below $90,000. That's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth is next.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we've got a little bit of a portfolio checkup for you. We discuss the dangers of trying to time the market and break down how investors can navigate short-term volatility. And state of the housing market. One expert tells us how improving inventory and easing price pressures should help potential buyers this spring. Plus, getting retirement ready. All week, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those over 70 living off of those investments and sipping mojitos. Today, we focus on your 40s and 50s, your final push to save. All that and much more during today's show. But first, let's start, as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. We're seeing declines across the board, fractionally for the Dow and the S&P 500, but the NASDAQ slippage is intensifying, down 1.7% right now. Let's make sense of this for you. Stocks struggling to snap a losing streak as investors navigate macro uncertainty. Joining me now on set, we've got Kevin Mahn, who is the Hennion Walsh CIO. Great to have you here in studio with us.
Great to be here, Brad.
An important day for you to be here in person as we're kind of tracking the slippage here. You're actually warning about the potential dangers of trying to time the market.
Yes.
Explain how you're viewing the recent volatility and what investors need to know.
Sure. To start, prior to yesterday, the VIX, which is a measure of volatility in the market, rose by 35%. And that caught some investors off guard. And you know why? Because last year there was little to no downside volatility, as there was less than 4% of the time the market closed 1.5% or more lower on a given trading day. That's a historically low level of volatility. But that type of volatility shouldn't cause investors to flee the markets or try and time the market. You know, Warren Buffett once said, and I agree, that the Hall of Fame of market timers is an empty room. Trying to time the market is an exercise in futility, because you got to get it right twice, Brad.
Right.
When to get out and when to get back in. It's when to get back in that is often more difficult and allows investors to fall short of their longer-term financial goals.
Right, and so that's where we hear this old adage, it's not timing the market, it's time in the market here. You know, how can you really make sure that you're allocating your assets for any market volatility that you have to weather?
Sure. I think you need to stay true to your risk tolerance. In other words, your risk tolerance shouldn't go up just because the market is moving higher, just as much as it shouldn't go down just because the market is moving lower. Build your asset allocation strategy consistent with your personal risk tolerance, your investment time frame, and ultimately what your growth and income goals are. There was a study done by a University of Michigan professor, and I recognize this study is somewhat dated, but he looked at 31 consecutive years of stock market returns. And what he found, Brad, was that 95% of the stock market returns come on just 1% of the trading days. Now, I don't have a crystal ball. I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on those 1% of the trading days, you're likely to miss out on the most significant returns the market has to offer, and they generally come after big down days.
With all of this in mind, for some of the slippage that we have been tracking here, a lot of investors trying to figure out where they should be reallocating.
Yes.
And you have, I think, trending on social here earlier this morning, I had seen even buy the dip.
Yes.
So if you're talking to investors right now who are trying to figure out what dips feel safe, or which dips actually might have a little bit more of a dippity dip coming later on here? It's a technical term.
Yes, absolutely.
Yes.
So I would look into those themes that are going to continue to resonate in the new year, or perhaps even over the next decade. I know the AI revolution is being called into question tomorrow. I think we'll find tomorrow afternoon, after Nvidia reports, that the AI revolution is indeed alive and well, and CapEx spending will continue there. But don't just look at those semiconductors and chips, please. Recognize the other opportunities that exist around there. How about power solutions, utility companies, SMRs, nuclear capabilities, or even the data centers, the cooling solutions for the data centers? I could go on and on. There are growth opportunities ahead. However, we're starting to see changes in market leadership now. We're seeing value outperform growth, international outperform US. Maybe now's the time to take some chips off the table and move into other areas of the market that may provide the leadership going forward.
As we're thinking about some of those attractive areas of the market, what are you playing, what are you fading right now?
So where I really like right now, I still like the utility sectors, particularly multi-utilities that pay good dividends, have strong balance sheets, and supply electricity, natural gas, and even nuclear power capabilities. I think people are shorting defense right now. I don't think defense spending is going to decrease as much as many anticipate. If you look at companies such as L3Harris or even Lockheed Martin, I anticipate more spending in those areas ahead. And then you go away from that. How about small cap biotech? If you're looking to be a little bit more aggressive and looking for growth opportunities, I bet you there's a pickup in M&A activity, and the small cap biotech companies will benefit from that.
Kevin, thanks so much for joining us here.
My
Critical
pleasure.
day to get some analysis here and get some insight. We appreciate it, Kevin.
Thank you.
Now time for some of today's trending tickers that we're tracking during the session. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith. She's been hanging around here. This is hour number 3 for you.
It is. You guys can't get rid of me offset today.
We cannot, and we don't want to here. Why? Because we got to talk about Chegg. Of course, everybody's going to remember this one, especially if you went to college and purchased some books from there. All those things considered, shares of Chegg plunging after the company sued Alphabet, claiming the Google parent's AI overview feature has blocked traffic to its website. The company says it is now exploring strategic alternatives, and in its lawsuit, Chegg accused Google of unfair competition, calling it, quote, a once robust but now hollowed out information ecosystem of little use and unworthy of trust. My goodness, fighting words. Chegg, which offers homework help for students, has seen its value fall over 90% since ChatGPT launched in 2022 here. You got some real sparring words that are coming through in some of the legal filings here, Shauna.
You do. They need to do something because clearly they're having a tough time turning this around. You're taking a look at that 5-year chart. It clearly lays out just the pressure that AI and AI adoption, the Main Street adoption, has certainly put on its business. Chegg is very much trying to figure out what their place looks like here going forward, what exactly that business looks like going forward. Right now, we're right around the lows of the session with the shares off just about 31%. And I think the large takeaway here from so many of the analyst notes that I've been combing through here this morning is there's a lot of confusion and uncertainty just in terms of what that timeline looks like for Chegg in order to regain some of that lost momentum. JP Morgan coming out saying that the company continues to face secular and competitive headwinds, driving to that lighter than expected Q1 outlook. Jefferies, Brent Thill over there, who comes on the show many times, saying that Chegg's business remains under major duress from AI. Piper Sandler also weighing in, pretty much affirming some of that sentiment, saying that subscribers are continuing to decline, a lot of that being pressured by AI adoption. So very much a clear takeaway from the street is there's a lot of concern, a lot of worry just about the continued pressure that AI adoption is going to put on Chegg's business. And there's a lot of questions as to whether or not the ability here to turn things around.
Yeah, down 30% on the day, now sitting just above $1 per share here. We'll continue to track that one. We're also keeping close tabs on Block this morning. Block getting a post-earnings upgrade to equal weight from underweight at Morgan Stanley. The analyst says that valuation is reflective of risks that they've outlined, including skepticism of Square seller growth acceleration. And Cash App valuation now matches the firm's expectation. Shares right now down by about 3.7% here. So a little bit of the evaluation that they have continued to run the calculus around here and kind of saying, yeah, this is exactly what we expected.
It very much is. When you take a look at, if we could pull up a 5-day chart, I don't know if we have that ready here, but a 5-day chart shows the decline that we have seen seen in Block shares since we did see that release. You're looking at the stock still off just about 25%. So very much this is a valuation call. Morgan Stanley, the latest name to come in, saying that it's now the risk, the sentiment and positioning, I think, is a little bit more balanced. This also follows a call that we got from BMO earlier this week. They also upgraded the stock. They actually did outperform from market performance, so a bit different than what we're hearing from Morgan Stanley this morning, who upgraded it to equal weight from underweight. But again, very much saying that they think the current valuation incorporates some of that increased skepticism. Block's ability to accelerate Square seller growth here is critical here to this upgrade. Their new price target of $65 a share, just about $1.50 higher than where we're trading today.
All right, Shauna, we finally release you from the set here today.
Thank you.
This morning, for
now.
right now.
I'll be back at noon.
Thanks so much for sticking around. Appreciate it. Also tracking consumer confidence, posting its biggest monthly decline in nearly 4 years, falling to 98.3. That is below the expectations for 102.5. The Conference Board says inflation expectations surged as investors digested an increase in prices for staples like eggs and the expected impact of tariffs. So we want to dig into some of this uncertainty and talk about how investors should be positioning themselves in the current environment. Joining me now in studio, finally live in living color, we've got Anthony Saccaro, president of Providence Financial Insurance and Services. Anthony, great to have you here with us this morning.
Thank you for having me. Great to be here.
Absolutely. So let's talk about this. You are calling for a measured approach for investors here. Walk us through that.
Sure. Well, the consumer confidence obviously has been down, and there's really nothing that's going to tell us that it's going to increase from here. It's all about inflation. It's all about tariffs. And as much as we would like President Trump to come out and say, look, guys, I'm just using tariffs as a political ploy. I'm really not going to impose them on anybody. We know that that's not going to happen. And we don't really know what's fact and what's fiction at this point. So the fact is that he is wielding them, but we don't know where that leads. If it's 10% or so, if they're real tariffs and 10%, companies can absorb that.
Sure.
And so I don't think that'd be a big deal. But if it gets higher than that, if it gets into some of the 25% range that he's talking about, now all of a sudden consumers are going to have a problem. But this is weighing on consumers' minds. So the sentiment is down because they believe that if he does wield them as a sword and if they do stick, then inflation's going to grow, and no one wants that. That's why consumer sentiment is down.
So what's the pass-through here for different generations of investors, say younger investors? Let's begin there. You say you should continue with the dollar cost averaging strategy. What does that look like in effect?
So dollar cost averaging is just buying the same thing over and over again. For those of you that have your 401ks that you're just having money taken out of your check, what you're doing is you're dollar cost averaging. And what it does, Brad, is it drives the average purchase price down, which is exactly what you want. You want to drive the average purchase price lower. The fact is that if you're doing that and you're in that younger generation, keep doing it. Volatility actually helps you because if you're buying consistently and the price comes down, then what's going to happen is you get to buy more shares for the same dollar. It's not bad. If you're closer to retirement, though, or you're in retirement, now all of a sudden you have to worry about a major pullback at the wrong time. If you're going to retire in 2 or 3 years and that market crashes maybe 20, 30 or more % from that, now it could cost you your retirement. So if you're younger, keep dollar cost averaging. If you're a little older, might not be a bad time to reposition into something more conservative. And my preference is to focus on things that pay interest and dividends because those are the eggs that you can count on.
Certainly. And so as we're thinking about that, let's delve a little bit further into those who are closer to retirement age. Where are the assets that you are seeing more people who are retirement ready and their savings feel like they're in a good spot to finally say, okay, maybe this year, maybe next year, 2 years from now, that we are retirement ready, but we still need a portfolio to kind of balance some of the opportunity that are still out there in the market?
Sure. Well, what you need to know is that almost any investment out there can be focused on either growth or income. Think about stocks. Yep. You have growth stocks out there that are high multiples and with the idea that the company is going to grow into the price, but there's no income. Yeah. Or you can buy dividend producing stocks that are going to pay you income, and the income is like the bird in the hand. You can count on that income. And so stocks is one example. Same thing with bonds. You can buy zero coupon bonds that don't pay you any interest at all until you cash them in later. Or you can buy bonds that pay income. So the reality is there's a whole universe of investments out there that are dividend and interest focused. Stocks, bonds, preferred stocks, business development companies, REITs, flavors of annuities that are all income oriented. And the income is the bird in the hand. You know you can count on it. If the market stays choppy for the next decade or so, and that's happened many, many times where there's been a decade or even two where there's no growth at all in the market, choppiness, but at the end of the day, no growth for 2 decades. A lot of people don't know that. If you're focused on dividend investments, then the fact is, you're getting paid to wait. And it's those dividends and interest that will come in and save the day.
What's the calculus that those who are closer to retirement should be running around corporate bonds versus treasury bonds, for instance?
So there's a spread, and it really depends on what that spread is as far as whether you should be doing corporates or treasuries. Usually it makes sense to invest in high investment grade corporates over treasuries. Right now the spread's probably 75 basis points and, very good. But as far as the calculus for you, for income, it really depends on how much income you need out of your portfolio. If you're retired and you're living off the income in your portfolio, you want to have a much higher degree so that you can live off that income, the interest and dividends. Whereas if you're retired and you don't need the income from your portfolio, then you can take that, put it back into more frothier, growthier stuff if you want, and you have time to ride it out. But if you need the income, the more income you need, the more you want to have in income producing investments.
Anthony, great to have you in studio with us today.
Thank you, Brad.
Appreciate it. Coming up, everyone, the state of the housing market. We discuss the latest trends in home prices and talk about the spring buying season. Stay tuned. Home Depot reported an increase in same-store sales for the first time in 8 quarters as homeowners and professionals both spent more on home improvement projects. And here to help break down what Home Depot's results mean for the housing market, we've got Yahoo Finance's Danny Romero. So what does it mean for the housing market right now?
Well, let's just start with the earnings, right? Home Depot executives were very happy with the positive comp sales, but it's important to know that Home Depot's CEO, Edward Decker, sees little life in housing turnover. So that's the change of hands between one house and the other house. So remember, over the past few years, the company has pinned their problems to the challenging housing market. But these issues will likely persist. The company projects a 1% growth in same stores sales. So remember, the point here is that high home ownership costs have contributed to this slump in existing home sales and also the reduction in home improvement spending. So, the executives here really aren't expecting a significant housing recovery here. So, this was just really shine the light on what can we expect here. Will people continue to stay at their house and, remodel it, or will they just put off the projects for a later date?
Yeah, that's major. The company's saying that the results exceeded their expectations. However, they did acknowledge some ongoing pressure on large remodeling projects, to your point here. We also got some housing data out this morning. Big day for housing. Case-Shiller, S&P Case-Shiller CoreLogic Home Price Index, that showed home prices increased 3.9% in December. What are the biggest takeaways from this report?
Home prices rose faster in December than last month. So really just providing little relief for home buyers. The S&P Case-Shiller National Home Price Index did, like you said, rose 3.9% from the earlier year in December. On a seasonally adjusted basis, remember this data captures a 3-month period through December when mortgage rates were just hovering around that 7%, a double whammy for buyers. And so the national index did hit a record high for the 19th consecutive month. So the thing interesting really here is that the one of the analysts at S&P Case-Shiller, he highlighted and said this, and this was just, I think, the icing on top. He goes, through this recent market cycle, the ability of Americans to grow wealth by participating in the upside of the U.S. housing market, particularly if done through a leveraged position by securing a mortgage, has proven to be historically beneficial. And I thought that was that says a lot, right? That homeowners have a lot of equity, and if they got in at the right time, that they're able to have some of these gains that we're seeing in home prices. The other thing is the index tracking home prices in the 20 largest metropolitan areas gained 0.5% in December, and also the largest 20 city index jumped 4.5% compared to last December. So really, I mean, it's just really highlighting that home prices in 2024, they hit a record high.
You know what's not great in this report for us? New York reported the largest annual gain again here among the 20 cities in that 20-city composite here, posting those year-over-year increases of 4.5%.
But we could say that that could be an influence of people moving back to the Northeast because of work.
Yeah.
Because of work reasons,
Return to
right?
office mandates.
Exactly.
Yeah.
So we could see that big jump.
Yeah. We're going to be continuing to track it very closely here. We got a lot more housing data coming out this week. Danny, thanks so much for breaking this down for us. Appreciate it. Using a different gauge than the Case-Shiller, annual home price growth pulled back in January, falling to just over 3% from around 3.4% the prior month. That's according to the Intercontinental Exchange's Home Price Index. Here to dig into the data and what it means for the housing market heading into the busy spring season, we've got Andy Walden, who is the head of mortgage and housing market research at Intercontinental Exchange. Great to have you here with us, Andy. So just take us into the reading as per the ICE metrics.
Yeah, and I mean, we saw the same thing late last year, right? So when you look at late 2024 home price growth, it picked up a little bit over the last 3 months of the year, according to our index as well. We're starting to see an inflection, though, as we move into January, and that annual home price growth rate is starting to come down. If you look at the better part of the last 9 months, we've actually been operating closer to a plus 2% annualized growth. So it suggests that, you're just talking about those high levels of home price growth. That annual growth rate could start to ease here over the next couple of months as, it more accurately reflects what's actually been happening here more recently in the market.
But we're still essentially within the same ballpark mortgage rate as we were this time last year. So there hasn't really been a ton of movement. How is that anticipated to be a differentiating factor this year versus last year?
Yeah, and it's slightly better as we stand here today than it was at this point last year. The other thing to keep in mind is as we move our way through 2025, if you look at the futures market and where the street is kind of placing its bets in terms of where mortgage rates are going to go, you're likely to see about a 0.25% relief in mortgage rates. At least that's the anticipation right now as we make our way through the year. And so a little bit of a modest reprieve in home affordability as we make our way through. The other thing that's very different today than it was a year ago is that there's more homes out there available for purchase. So if you look at the market in January, there were 25% more homes available to buy in the market than there were at this time last year. We're seeing the strongest inventory levels, even though we're still running a deficit, the strongest inventory levels that we've seen really in the better part of the last 5 years out there in the market. Now, you guys were just talking about New York City and home price growth that still remains strong in that area. There's a lot of variation across the country in terms of inventory deficits and where we stand right now. The Northeast is really still starved for inventory. And so that's why you're seeing some of those stronger home price growth rates up there. When you look across the Sun Belt, a good chunk of those markets are back now to pre-pandemic levels of inventory, and that's where you're starting to see prices soften.
Okay, and so there we go. We're taking a look at some of where prices have softened, and a green arrow in this context means good, even though it's pointing down, because ultimately that's some relief for potential buyers out there. All those areas that you're tracking right now, how much of this can you tie back to some of what we were discussing in return to office mandates, or just migration that now once again has to unwind because we can't be as hybrid as we were before, I guess?
Yeah, it's a combination of all of those things. And when you look at the Sun Belt, you start to look at new construction activity down there as well. There's a stat that 3/4 of new home construction coming to market last year actually came in the Sun Belt. And so that helps for some of those existing homeowners that are still locked into their homes by low rates. You're seeing some of that new construction inventory help with the supply constraints down there. You're also seeing a number of other factors, rising property insurance in those particular areas, the migration inflow that's slowed down into those particular areas, back to office in New York, right? So there's a number of different factors that are contributing to this, but really it's that inventory component. It's not so much affordability that's driving price right now or the lack thereof. It's inventory. And when inventory returns, you're seeing those prices soften up. In areas where you're not seeing that inventory return, the Northeast most notably, you're seeing still firm home prices.
With that in mind, as you're thinking through some of the policy implications that could have an impact on housing, whether that's the workforce and immigration policy impacting the number of available workers to build out homes, and then additionally on the materials itself, if we do see tariffs go into effect, how could that also have larger impact on the cost of new home build-outs?
Yeah, you're absolutely right. That new home construction is where that would come, both in terms of the lack of labor from that lack of immigration out there in the market, along with tariffs. If they're put specifically on lumber or construction materials, that can have an upward pressure on homes that would be coming to market over the next couple of years out there in the market. So something certainly housing market folks have a close eye on. What do we truly see in terms of these tariffs? You were having that conversation earlier in the show. What do we see in terms of immigration and the costs of this construction, and how does that play into the market as well?
As we're taking a look at some of the home builders here, home builders rallying on the day, at least during this activity. Andy, we're going to continue to track this very closely here. We appreciate you taking the time.
You bet. Thank you for having me.
Coming up, everyone, congressional Republicans are taking aim at 2 new rules from the CFPB. Find out what these rollbacks could mean for you and your finances next. Congressional Republicans taking aim at 2 rules designed to protect consumers created by the Consumer Financial Protection Bureau in the final weeks of the Biden administration and potentially blocking them from ever taking effect. Here to break down the rollbacks, we've got Yahoo Finance's Jordan Weissman. Jordan, let's start with the cap on banking fees. What do we know there?
So during the Biden administration, the Consumer Financial Protection Bureau capped overdraft fees at $5, right? We all had an overdraft fee at some point. You accidentally took your account below zero without realizing it, and you get hit with like a $30 charge. Everyone hates it. The CFPB said no more. We're going to cap them at $5 or no more than the cost of offering that quote unquote service. This was part of Biden's war on junk fees. What's happening now is the Republicans in Congress want to use a law known as the Congressional Review Act to try and undo that regulation. And what the Congressional Review Act does is it lets Congress and the current president basically scrap recently finalized regulations, whatever the last White House was doing at kind of the last minute during its term. So, what it means is that this rule that was going to make all of us have to worry a little bit less about, getting hit with a surprise charge is probably going to, it's going to say goodbye.
There's also a rule regulating digital payment apps. So what's at stake for consumers there?
Right. So this one isn't going to hit consumers necessarily as directly, but it's still important. Basically, what the CFPB did was towards the end of Biden's term, it finalized a rule saying we have authority to supervise digital payment apps and digital wallets, Venmo, Apple Pay, and potentially if Elon Musk's X ever launches a large payment service, they could have been covered by this rule. And what supervision means is it's sort of a term of art. It means that regulators get to go in and proactively look at what companies are doing and make sure they're not violating any laws. The CFPB already supervises big banks to make sure they're not violating consumer protection laws. This would have subjected payment apps to the same sort of regulation. Tech companies didn't particularly like it, and already Republicans are signaling they might try to scrap this rule also.
Jordan, thanks so much for breaking these down, tracking these developments as well. We appreciate it.
Yeah, thanks for having me.
More than 3/4 of Americans cutting back on spending in effort to navigate persistent inflation, according to the latest Wells Fargo Money study. Here with more on the study's findings and what it tells us about the U.S. consumer, I'm joined by Michael Learsh, who is the Wells Fargo Head of Advice and Planning. Michael, great to have you back here in studio with us this time. So let's start there. How does the cutback in spending compare or stack up to last year?
So last year, it was about 67% of Americans say they were going to cut back on spending. But what's more interesting, Brad, is the generational cut. So think of those Americans in their 20s, 30s, and 40s. They're cutting back the most, but in favor of saving and investing. So the majority of those audiences say they want to save and invest more this year as well.
Okay, so they just want some time in the market here, based on some of the other conversations we had earlier today as well. Many Americans are delaying, it seems, as well, the plans of, other just broader life goals as well as part of that spending pullback. Where are you seeing them cut back specifically?
So it's interesting. We're seeing vacations in particular being where a lot of people are making trade-offs. And that makes sense, and they're not saying they're not going to do them. They might be delaying them, doing those vacations a little bit differently, maybe, again, cutting back on expenses. And you had a lot of the kind of home data. A lot of people are reconsidering when they want to do a home renovation or relocate or buy a new home. So there's just a lot of uncertainty out in the marketplace right now, and people are trying to make those good trade-offs so that they can sustainably, Brad, meet their savings and investing goals.
So not quite taking the White Lotus trip, but maybe just popping over to the beach or something for a weekend. Who knows?
Yeah, absolutely.
That could be it. Yep. Turning here as well to sticker shock, because this was interesting as well. How are Americans across different incomes just feeling about prices right now?
So when Americans, we ask them about very basic things, tank of gas, going out to eat, and buying a bottle of water. So think about a bottle of water. Americans said they expected to pay about $1, Brad, and they really paid $3. So in just those life basics, they felt like inflation had really caught up with them. And that's what's driving a lot of this reprioritization, which is actually exciting because people want to align their values with how they're spending rather than just going through life and doing things more out of convenience.
Was there a specific item that jumped out to you that costs more right now than people expect, that's catching them off guard?
So birthday and holiday cards actually caught me a bit off guard. So it was $3 that people expected to pay, and then they turned over the card and they were paying $6. And you can imagine at the holidays, and people probably remember it very recently, that can be a lot of money if you're buying 5, 10 cards for your friends and family.
Yeah, all right. Good for me. I have a binder. I save everybody's cards that they give to me, so just know I keep them. So as we're thinking about where people can ultimately find some relief here as well, what tips do you have for those who are looking at the sticker shock or looking at the prices of things or even delaying some of the life plans and just trying to get into better stature to position themselves to be able to execute on all of the things on the vision board?
Absolutely. So I'm going to anchor in what Americans told us. So they said they wanted to reset their financial habits. And when we looked at the data, though, they were also keeping money kind of a secret in terms of what they were doing with it. So what I would encourage Americans to do is find a trusted partner or professional, Brad, and really share what's going on with their money. And then in that way, to your point, have that goal board, align what you're doing with your money, with your values, and how you intend on spending it. The second thing Americans said, and I mentioned this, is that it's the right time to save and invest now. So in the same vein, what does that mean to you? How much do you want to save? What are you investing for? Is it retirement? Is it just to build wealth? Really focus on that and get it done, because Americans said the time is now to save, invest for your future, and also to make sure you're being very intentional about it.
I'm going to marry together two thoughts here. One in the conversation that we're having, and then another in what we were discussing the other day with layoff anxiety that's very real right now for many Americans, as shown up in one of the studies that we were discussing just yesterday. As you're kind of thinking through the number of people in the workforce that have that anxiety about layoffs and also trying to monitor their finances, is one translating into, or at least transpiring into, purchase habits as well and perhaps having some impact there?
So we did look at income data.
Okay.
And so for those people who are higher earners, I will tell you, Brad, they're still saying they want to cut back on spending this year, and about half are saying they want to do that for the highest earners. So to your point, you could call it anxiety, you could call it uncertainty, whatever you want to call it. People are aware that there's uncertainty in the economy, and they want to manage to it. And what's great about it is Americans aren't just living their lives and going about business as usual. What they want to do is take control and agency of their own financial lives and future.
Some really great insights and context here. Michael, great to see you. Thanks for joining us.
Great to see you too.
Before we go to break, this Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, and proven change makers who have advanced economy and society. Fawn Weaver is the Grant Sidney CEO, co-founder of Uncle Nearest, and two-time New York Times bestselling author. She's known in the spirits industry for her leadership of Uncle Nearest Premium Whiskey, which is founded to honor Nathan Nearest Green, the first Black American master distiller who mentored Jack Daniel of Jack Daniel's whiskey fame. With Weaver at the helm, Uncle Nearest has become the top-selling Black American-owned spirits brand with a valuation exceeding $1 billion and tripled sales between 2021 and 2024. She also co-established the Nearest Jack Advancement Initiative, a partnership with Jack Daniel's aimed at promoting diversity within the whiskey industry. Coming up, we have some advice on saving for retirement in your 40s and 50s. Stick around. This week on Wealth, we're taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out their 401k match to those who are over 70 living off their investments. And today, we're narrowing in on how to save in your 40s and 50s. Fidelity found that the average member of Gen X has an average of $192,000 saved in their 401k, but also have the highest rate of outstanding 401k loans out of all generation. Here, with some advice for the middle-aged retirement savers, we've got Andrew Fincher, who is the VLP Financial Advisor. Andrew, good to have you here with us today. How much should people have saved by their 40s?
Yeah, Brad, thanks for having me on. Really appreciate it. So it's something we like to say in the industry, and I know people want a number, but it really depends, right? So you got to really think about where you're coming from. It factors in cost of living, taxes, and lifestyle as well. Some people want to live off of 150,000 a year. Some people are comfortable with 50. And so when you look at it that way, what we try to see is goals-based planning. What that means is see what your future looks like. What number do you have to live off of? Consider costs such as cars that you need to repurchase, care in retirement, and then work backwards to see what assets you have to know how much each year you should be putting for retirement.
That's nice. I like that. Goals-based planning here. Okay, so how do you run the prioritization calculation around that goals-based planning?
Sure. So we do categorize it into needs, wants, and wishes. So your needs are definitely going to be your typical retirement savings. We typically break out of that your medical care. So your Medicare premiums, if you have private insurance, what does that look like? And then again, vehicle repurchases. If you go over to the wants, that's sort of vacation, right? People typically, maybe you want to travel abroad. Maybe it's just to the lake down the road. Either way, there's a cost associated with that. And then wishes is, maybe you want to pay for your children's wedding, or maybe you want to leave a bequest to them, or charitable contributions, whatever that is. We categorize it to know you need to start at the needs and then work your way down and see what probability of success is for that.
So how do catch-up contributions work for those who feel like they're a little behind the eight ball, or perhaps not at that $192,000 in their 401k? What can they do to catch up?
Sure. So this is a great wrinkle that was just added by Secure Act 2.0. So I know a lot of people know the deferral number is 23,500. However, there's these new layers with the catch-up. So between ages 50 to 60, you can contribute an additional $7,500 for 30,000 total. And then on top of that, from 60 to 63, there's the additional $11,250. So Congress got together, and if you have cash flow that allows for it, it not only helps you save for retirement, but also reduces your current tax liability as well if you're in higher tax brackets.
How and what is the best way to go to just calculate how much you need for retirement?
Sure. So, a lot of factors in that. Inflation is going to play a role, right? So typically you got to look at inflation from a 3%, maybe 2.5% if you're quite bullish on it. Medical expenses, 5.5%, 6%. If you're saving for college, for instance, that's even going to be higher. And you got to look maybe more specifically on which college, because again, private could be more expensive than public, depending on the state. So factoring in these things, if you utilize software, we utilize a software called Money Guide Pro. There's others called eMoney. Banks have them as well. But if you put these factors in and try to make sure that you're including appropriate amounts that are going to grow each year, that allows you to work backwards to say, hey, this is the amount that I need to put in to be able to get to our goals.
So what are the percentages that you need to think about saving for different types of expenses, right? Because it's not just like you're going to draw upon this figure, be able to go upon some vacations to some perhaps lavish destinations, and then also you're going to have your normal expenses, your house, maybe some medical things that pop up too. So how do you go about calculating those specific percentages in each of those buckets?
Sure. So obviously the large base is going to be your living expenses, right? Just your groceries, if you have a mortgage or rent. Car purchases are going to be a big part of that as well. And so typically you have a good idea of what you're spending. If you don't, always look at your budget, see if there's margins that you can sort of create that cash flow. As far as other things, whether it be vacation, it's sort of you have to weigh your options there. So maybe a typical vacation for you is 5,000, 10,000. You look into that. That's the great part of these softwares is it actually will shoot out a probability of success for you. So if you utilize this and say, oh, maybe you want a stretch goal of 15,000 for a vacation, put it in there, see the probability. Then you can lower it and go through and see, okay, this is the constraint that we have for this specific goal.
I can't wait until my average vacation is 5,000, 10,000. Andrew, you've put an aspirational goal out there for me, and now I've got to work with ChatGPT to figure out how I can get to it. Andrew, appreciate it.
Appreciate it, Brad.
A programming note, in this week's special episode of Decoding Retirement, host Bob Powell speaks to Wharton School professor Olivia Mitchell, who shares results from a study that looked into financial regrets in an older age. Take a listen.
Well, we've done a fair amount of work trying to study what older people do regret. And we were surveying people over the age of 50. And we asked them questions like, we didn't use the word regret because that would have been too leading. But we said things like, looking back, if you had to do it over again, would you have liked to have saved more, about the same, or less? And a majority of the respondents said they wished they had saved more. Only 2% said they wished they had saved less. So definitely regret for not having saved more along the way was very salient.
You can catch episodes of Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Coming up, Yahoo Finance's tech editor Dan Halley breaks down the journey of how Nvidia grew from a gaming company to Wall Street's AI darling. And ahead of Nvidia's earnings report Wednesday, Yahoo Finance, guess what? We went to the streets, to New York, to ask everyday investors how they're deploying their cash and whether or not Nvidia is part of their portfolio. Take a listen.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be like better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings reports of Nvidia. I think it's definitely going to be positive.
With a market cap of over $3 trillion, Nvidia is the second largest company in the world and a major influence on the U.S. market and beyond. The company has been public for more than 25 years, long before artificial intelligence was dominating headlines. So where did the company begin and how did it get to where it is today? Here to explain, we've got the tech editor for Yahoo Finance, Dan Halley, breaking it all down for us in the evolution of Nvidia.
Yeah, Brad, this is a company that started off really primarily on video games. I know a lot of people are aware of that, but they are also consider themselves the creator of the graphics processing unit. That was the original GeForce 256, and the graphics processing unit basically was a way to offload some of the calculations that a CPU would use when rendering games. And so they managed to come up with that. And that basically helped video games kind of explode as far as graphics capabilities. They are since now used in high-end gaming PCs. I have one in my PC. The original Xbox was powered by a GeForce chip or an Nvidia chip. And so is the Nintendo Switch, believe it or not. It's a Tegra chip that kind of came around when Nvidia briefly got into smartphone sales. But they've also been able to see over time through research that these cards are great at something called parallel processing. And so as a result of that, they can handle certain tasks a lot more efficiently than a CPU. And so over time, researchers started to realize this and experimenting with the power in different applications. Then in 2006, NVIDIA released what it calls CUDA, which essentially opens up its hardware for use by researchers for general purpose processing. So this is GPU, general purpose processing, and it's basically the foundation of what we have today with AI. Then in 2012, there were a trio of researchers, including Ela Stutzkever of OpenAI, co-founded OpenAI. They came together and created what is called AlexNet. It was a neural network. It won the ImageNet image recognition competition. Basically, this is considered to be a seminal moment in the AI revolution. It was able to figure out how to find a photo of a cat. And it's been this enormous kind of, people call it the Big Bang moment for AI. After that, Nvidia, Stutzkever ended up going on and opening up OpenAI with Sam Altman, Elon Musk. Later, in 2016, Nvidia actually delivered its first DGX-1 supercomputer to OpenAI. And we have this image here with Musk looking at it with Jensen there standing alongside him. And that's the original DGX-1 computer. And then obviously in 2022, after all of this kind of work was going on, OpenAI finally launched ChatGPT. And that set off the current AI wars that we're seeing today, where we have Claude, we have Gemini, Claude from Anthropic, Gemini from Google, as well as a slew of others. Microsoft obviously investing heavily in OpenAI over the years, and now Elon Musk split off and has XAI. And so there's all of these different companies now that are just going bananas. We're seeing the stocks jump on these kind of companies, AMD fighting to get in the space, Intel as well, but it really is NVIDIA's game, and this is kind of how it's gotten here.
All right, earnings coming this week, the 26th. Dan, can't wait. Appreciate it. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes your way at 3 p.m. Eastern Time. They'll count you down to and through the market close.